loan of 2 million on 1st December 2020 to assist in offsetting the mortgage loan. The market interest rate was at 12% per annum. And number 12, the company paid him a monthly telephone allowance of 5,000 shillings. His other incomes included farming loss of 140,000, rental income, commercial building 96,000, dividend in bracket net of tax of 47,600 from Hazita Cooperative Society. Then professional fees 78,000. Required total taxable income for Benson Kapila for the year ended 31st December 2020. And number 2, tax payable, if any, for the income computed in under. So you write the name of the person you are computing the taxable income. So you write here Benson Kapila. So you must write here Benson Kapila, computation of taxable income, computation of taxable income, year of income, or for the year of income 2020, and then you underline. So the year of income for the purposes of tax from January to December. So you must write the title there, and then you write here shillings. So now we said you are listing the benefits, the gains you are getting from the employment income. You're only listing the gains you're getting from the employment income. Are we together? So the first gain there is not number 1, the basics are basic pay. So you are listing the gains you're getting from. So you have been given the basic pay of 61,400 net of pay, So you're just going to write 61,400 and then you multiply by 12. So now when you're listing down the benefits, the key consideration is the duration when the benefit was provided. In some other question, the duration, the period might be 2 months, another one 4 months. So you need to be very keen. Was this benefit given for the whole year or not? So that is, you need to be very keen. So what do you get there? Sorry? 736, 800. Number 2, he was provided with a house by the employer, which was furnished at a cost of 200,000. So in that note, number 2, we have 2 benefits. We have the housing benefit and the furniture. So we said when you're given a house that is furnished, those are 2 benefits. The house is a benefit on its own and the furniture. So you need to check, was the housing provided for the whole year or for only a part of the year? So in this question, on 1st October 2020, according to note number 8, he moved to his own house, meaning he left the furniture and the employer's house. So now, how many months are those where he was being housed? 9 months, isn't it? So now furniture, you're going to write here furniture. This is a benefit. So for furniture, we said it's 1% per month. Some people are writing 12%. So you need to be very keen. It's 1% per month. And the duration of the benefit. So times 200,000. So what do you get? Furniture is 9% times 200,000. What do you get? 30? So you get here 18,000. You write here very clearly 18,000. So write it very attractive so that whoever is marking your work find it very nice to mark it. So. And then next one, he is a member of a registered retirement pension scheme. His monthly contribution was 30,000 and the employer contributed at 2,000 per month. So now there we have 2 things. The contribution that the employer is making on your behalf as an employee to a registered pension scheme, we said is an untaxable benefit. So you don't write it here. That one is an untaxable benefit. So the employer is contributing on your behalf to a registered pension scheme. That one is an untaxable benefit. The one that you're contributing for yourself as an employee, that one is not a benefit, isn't it? Some people are writing here. That is anything that is coming from your own resources. It's not a taxable benefit. However, it qualifies as you to what? A deduction, which we call allowable deduction. So number 2, you leave it. In some other question, they will ask you to comment on items not used. That is the comment. You say contribution by the employer on behalf of an employee, non-taxable. Those are the comments you make. We go to number 3. He's a member. Number 4, sorry. He was provided with a company car, 2000 cc, whose cost at 1st January 2019 was 800,000. So here we have the car benefits. Car benefit, you write here very clearly, car benefit. So you check the CC ratings. The CC ratings, where do you get the ratings? These are provided. I want to imagine every one of us is able to be able to read those ratings. So the ratings of this car was how much? What is the rating given? Sorry? Ukiangalia hapo unapata ngapi? Mnaongea polepole. Hakuna mtu ama leo ni Friday mmefast kuongea. 7,200 per month, and then per year, because the car was given for the whole year. So 86,400. Yeah, 86,400. And then you compare with 2% per month on the original cost. There's a difference between the original cost and the net book value. The net book value, it is the cost minus accumulated depreciation. Here, you confine yourself to what? The cost. So here you take 24% times the original cost, which is 800,000. And then you get what? How much is this? 192,000. And then you write here, you pick the higher of the two, which is 192. And then you write there to the extreme right. That is note number 4. And note number 5, he was given per diem of 10,000 shillings for 5 days. So in other words, this 10,000 covered for not 10,000 per day. It is 10,000 for 5 days, isn't it? So when you divide that one, you get per day was how much? 2,000 per day. So here you write here per diem. So 2,000 per day. And then you minus 2,000, isn't it? And then you multiply by 5. Then you write here dash. So it's not taxed. So that one is exempted. Number 6, he's a pensioner and received monthly pension of 35,000. So in other words, he was employed elsewhere and he retired before he was employed again here. So that one is other incomes. This is not income originating from the current employer. This income coming from another source. So you deal with one particular source first before you go to another one. Don't mix incomes. If you're having a variety of incomes or you don't mix them together for the purpose of tax, you need to show each and every source separately. So some other people are writing that one here. You don't indicate it here. Once you finish with this employment income is when you come and consider those other incomes. Tumeelewana? So if you're working elsewhere and then you retired, you are entitled to pension if you are contributing to a pension scheme. That is not income from employment, the current employment. So don't write it. Here we are only listing things that relates to the current employment. We go to the next one. Number 7, he's a member of Home Ownership Saving Plan, HOSP. He contributed 16,000 per month up to 30 September 2020. So we said when you're contributing to a home ownership saving plan, you are contributing as an employee. So that one entitles you to a deduction. A deduction, that is a reduction of your total taxable income. It is not a benefit. Some people are writing it here. It is not a benefit, that one. It is a deduction item. It reduces your taxable amount. Home ownership saving plan. You are saving to buy your own home or to build your home. It is possible you can save to buy a home, isn't it? You don't need a lot of money to build a decent house in Kenya here. Once you have the stones, you are done, isn't it? Which costs around 100,000. Sawa, ukikuwa na mawe umemaliza hiyo biashara. Plot itakuja baadaye. Tunaendelea. Next, number 9. He has an education insurance policy for his children where he pays a premium of 7,000 per month. He pays. This premium is being paid by himself, not by the employer. If the employer was the one paying the premium on his behalf, then it would be a taxable benefit. But he's the one paying from his own money. So that one is not. The reason why that sentence is there, so that you remember to give him what we call insurance relief. Some people are writing here. I could see they were mixing there. So that is here we are listing benefits. If you are contributing for yourself for insurance premium, is that a benefit? It is not, isn't it? or is a benefit? Number 10, he enjoyed free company products during the year whose value was estimated at 56. So he says, provided this benefit value is more than 36, the entire value is taxed. So you write here, free products, 56,000. Remember, if this value is 36, is less than 36,000, it is tax-free. It is not taxable. It's not taxable. But if it is 36,000 and above, it is taxable. Number 11, the company gave him a 5% loan of 2 million on 1st December 2020 to assist in offsetting the mortgage loan. The market interest rate was at 12% per annum. So this is, you need to compute what you call the fringe benefit tax. You don't compute it amongst these items. After you're through everything, you could just compute it aside. Don't incorporate it in this other one. So that one is one of the benefits that you get from employment, that is tax on the employer. And then number 12, the company paid him monthly telephone allowance. Telephone allowance, with allowance, so telephone allowance, telephone, you take 30% of the bill, 30% of the allowance, which is 5,000 times. Is it 12? Sedio? So monthly of 5,000, then you multiply by 12, you take 30%. Nakuja ngapi? 18,000. So up to number 13 relates to other income that are not connected to employment. So up to this point, we have exhausted all the employment gains. Then you write here total employment gains or benefits. Employment gain before house benefit, before house benefits. So you add them together. What do you get? Eh? 10, 20, 800. And then now here you come and compute the house benefit. House benefit. So house benefit is 15% of 10, 20, 800 times 9 out of 12. He was in that house for 9 months. So you haven't been given the fair market rental value. So this one is going to be the house benefit. Where you're not being given the fair rental market value, the house benefit will only be 15% of the total gains from employment. If they had given us the market rental value of the house, then we compare with the 15%. Whichever is higher of the two, we pick it as a taxable benefit. Here, we have not been given the fair market rental value of the house that is given. So how much will this one be? 114, 840. At that point now you come here and say less allowable, you less now allowable deductions. You less allowable deductions. So the first one is pension. He was contributing to a pension scheme. So the actual contribution he was making himself, not the employer. So he was contributing how much? 30,000 per month, and then you multiply by 12. How much do you get? So this one is 360,000. This is for the whole year. And then there is the set limit. The set limit is 240,000. And then you take 30% of 10, 20, 800 plus 114, 840. So what do you get? Sorry? 340, 692. Here you pick the lower of the three, which is 240,000. So you put it in bracket like this to show deduction. Number 2, we have home ownership saving plan. You can just write HOSP, no problem. So HOSP, there is the actual amount he was contributing. We go to the HOSP. Not number 7. He's a member of home ownership saving plan where he contributed 16,000 per month up to 30 September. So he contributed 16,000 per month, 16,000 up to 30th September. So that is contribution how many months? 9 months. So you multiply 16 times 9. What do you get? Huh? So this is 144,000. The set limit is it is 48,000 per annum. So you divide by 12 to get per month, and then you multiply by 9. So you write here 36,000, and then you pick the lower, which is 36,000. You deduct that one. And then there is a mortgage interest. Mortgage interest. What is a mortgage? A mortgage is a loan that you take to construct your own residential house. So this loan attracts the interest. It's the interest that is allowable. So we come here and say there's the actual interest that he paid. The actual interest. So when was the loan given? So on 1st October 2020, according to number 8, he moved to his own house, which he acquired through a 12%, which he acquired through. So now, according to me, this mortgage was given in October. According to me, how do you reason it out? Notice how it gives you an open. It was given in October, not in January. Sindio? Sahi mtu akikupatia 3.6 million. How long will it take for you to have a house? 3 months? If you are interested in a house and I give you 3 million, you are interested in a house that is equivalent to 3 million, and I give you 3 million today. How long will it take for you to have that house? You can have it, you can rather than lala ndani kesho, ndio? So unaenda ununue. Hata kama ni if it is to construct, if you have all the materials, it doesn't take long to come up with a house, isn't it? So the problem is when you don't have funds. So now here, the interest is, according to me, it is 12% per. This 12% should cover the whole year. So it should be 12 over 100 times 3,600,000, and then you multiply by, you prorate 3 out of 12. Why 3 out of 12? 3 months. It was on October. Then set limit is just a minute. Hii kifaa yako inawaka inazima. Wachana na addition bwana. Concentrate. Kubwa wenye watu. So the set limit is 300,000 per annum. So it is 300,000 per annum. You divide by 12 to get per month, and then you multiply by 3 to get per for the 3 months. So what do you get? So this one is 75,000. Is it so? And the other one is 108,000. So you pick the lower, which is, so you less there. Any other thing? At that point, we have exhausted everything from employment. So you write there, total taxable employment income. Total taxable employment income. At that point, you have exhausted everything. So you add all this, you add this, and then you subtract. 10, 784. So this is 784, 640. And then if the other incomes, now you come and consider them. So we have other incomes. Other incomes, you come here and write So the first income is pension. The pension. So the pension is being given pension of how much? 35,000. That is an income. 35,000 times 12. How much is that? 3 for 20,000. And then we said when you are receiving pension in form of annuities, annuities is a regular payment. You exempt. So there's exempt. Exempt is 25,000 per month times 12, which is 300,000. So you exempt. So the amount that will be taxed is how much? 120,000. So there's a difference between this one that you're contributing currently and the one that you're receiving. I hope you can be able to see the differences. Tunaelewana? So some people are just mixing these things here. And then there is, we go to note number 13. Farming laws. When you get a loss, it's not taxable. So you write there farming laws. And then you write dash. Losses are not taxable. And then we said rental income, commercial buildings. So if you have a rental income, either residential buildings or commercial buildings whose rental income annually is less than 10 million, the withholding tax is final. So rental income here, rental income, withholding tax, final, dash. We go to dividends. So we say dividends, we have two kinds of dividends. We have three kinds of dividends. We have what we call qualifying dividends. These are dividends received from companies and circles. So if you receive dividends from companies and circles, the withholding tax is final. And then non-qualifying, this is non-qualifying dividend. Dividend received from cooperative societies other than circle. So how do I know that this is not a circle? We don't have the word circle even in the naming of that particular society. It is just written Hazina Cooperative Society. So there's no circle there. So that one will be taxed. Dividend here, so we write here dividend. So this one we said you determine the gross amount. This amount that is given here, 47,600, they are saying it's net of tax. Of course, they have withheld a tax of 15%. So this amount is equivalent to 85%. Now, what is 100%? So it is 100 over 85 times 47,600. Nakuja ngapi? So you write there 56,000. Tumeelewana? And then kuna professional fees. Professional fees, you add there. Professional fees. So this is, if they have told you net, professional fees attract a withholding tax of 5%. You need to determine the gross. But here they are silent. So you just write here 78,000. And then here you get the total taxable income. Total taxable income here. You get the total taxable income. So you add this 784 plus this 120 plus this. What do you get? Sorry? 1038, 640. And then now here you come here and compute the tax liability. Tax liability. So you take this 10, 386, 40. The first 288,000 is 288,000. The rate here, you write the rate, and then here you write tax. So the rate here is 10%, which is 28,800. So you subtract. We subtract that one. What do you get? 750, 640. This is the first. And then the next 100,000 at 25%. So this one gives you 25,000. So when you deduct this one, what do you get? 650, 650, 640. Even. So this one at 30%. Takuja ngapi? 185? 185, 192. And then you add all of them, you get the gross tax payable. Gross tax payable. So you 195. This one. 195, 192. And then you add all of them. Sorry? 248,992. Then you less pay as you want. Pay is how much? 18,600 times 12. Unakuja ngapi? 223. You also less personal relief, which is 28,800. Then you less insurance relief. Insurance relief. So you are entitled to a relief so long as you're contributing to an education policy or life policy, whether you are the one contributing or it's the employer contributing on your behalf. So that will be 15% of how much? Was contributing how much? 7,000 per month. So 15% of 7,000 times 12, which is 12,600. So this one will be 12,600. So you deduct that one. And then you realize withholding tax on dividend, withholding tax on dividend, withholding tax dividend, this one. 15% of 56,000. So that is advanced tax. Now we're happy. 15% of 8,000, 8,400. This one, the withheld tax is considered as advanced tax. The same thing will have happened to professional firm if they had told you net of dividend of tax. So you come out to Elawana, and then you add all of them. So that is how you should have done that question, and you earn the marks that are required for you. So we shall keep on doing more questions on this particular topic. But as far as I'm concerned now, that is the much we need to know. So we shall keep on doing, because we said, as we have identified, it is appearing in every sitting. So at your own free time, attempt November 2019. Now in November 2019, question number 3B. November 2019, question number 3B. And May 2019, question number 3C. So attempt those one. November 2019 and May 2019. May 2019, question number 3C. May 2019, question number 3C. And November 2019, question number 3B. So November, we are doing that in the 2019 paper. Both May and it had 2 sittings then. Ukipata negative ni refundable. Unaenda kurefundiwa na KRA. Umeoverpay. Sasa. KRA wako na pesa mingi watakufund. So hapo unaandika tax payable refundable. Tax payable stroke refundable. Kama ni refundable utaandika hapo itakuwa negative. Kama ni payable itakuwa positive. Huyo mtu ataona tax payable stroke. Hizi ni kubwa. Ikiwa negative ni refundable. Lakini unajua hizi scales, hizi rates za zero time ilikuwa kubwa kidogo. So unajua hizi rates wana keep on changing. Si unaelewa? Hizo rates za hiyo time zilibadilishwa kidogo. So tumeelewana? So now we want to do what we call taxation of business income. Taxation of business. I want to share some notes on taxation of business income. Taxation of business income. Taxation of business income. So we want to do topic number 3, taxation of business income. So tuko karibu kumaliza syllabus. Sasa wewe ukiona ati mtihani ni huko mbele, mtihani tunamaliza saa hii. Sasa so I have shared some notes in your group. If you're an online student, please, and you don't have these notes, make sure you ask so that we have the notes. Zimefika kweli? Imefika? Eh? So we have the business, taxation of business income. I've shared some notes. So we need to discuss some background info, what you need to know, so you're able to tackle questions on employment income. So we don't need this. So taxation of business income. That is our next topic. Taxation of business income. Taxation of business income. So in Kenya, we said we have 5 sources of income that, or most of the part of the world, that are considered for tax. So we have what we call employment income, business income, investment income, rental income, and farming income. So those are the incomes that are taxed. So already we have considered employment. So we want to look at business. So now there are factors you consider in order to determine whether there's a business being carried on for tax purposes. So when you look at that handout, this is one of the specified sources of income as per section 3, subsection 2 of the Income Tax Act of Kenya, that is. Subsection 3, subsection 2 describe the following specified source of income. So we have employment income, as I've mentioned, business income, investment income. Investment income, so far we have done at this point, we are able to tackle employment income and you're able to tax investment income, isn't it? So now I want to look at business income. And we also have rental income. I also believe you can do that. And then farming income. So now what are the factors that you consider in order to determine whether a business is being carried on for tax purposes? Number one, you look at the motive of the business. The motive is the heart behind the heart. Ukisikia ati Mungu anaangalianga nini? Roho yako. Roho ya mtu si ile roho iko ndani ya mtu. The roho ya mtu ni motive. The motive behind doing something. Ndio. Unaweza fanya kitu mzuri lakini motive mbaya. Unafanya kitu mzuri lakini motive mbaya. So your motive is not that good thing that you are doing. So we look at the motive of your doing. So if the motive is to make money, for example, if you just sell your phone once, then you don't have the motive of doing big. But if you sell and go and the amount of money that you receive, you go and buy another one. And then you sell again. You keep on doing that. Then the motive is B. The spirit is B. Business. So the motive is the reason, is the heart behind something. So we look at that motive. And then number two, the nature of assets acquired and the quantity involved. You look at the nature. For example, you cannot buy a lorry for your own personal use. You're buying a lorry for your own private use. Can you do that one? If you buy a lorry, then it indicates that you want to do business, isn't it? You look at the trailer. You can't buy a trailer for your own private. You want to be using it to go to some part of the country. That one will not. So the nature, we look at the nature of the asset that you've acquired. Or you can't construct such a building for your own residential house, isn't it? Unless there's something wrong. And then number three, methods of financing. If the asset, the products are used, the money, the proceeds from the products, you use it again to buy other products for resale, then we say that. Then the method used to generate sales. Do you engage in advertising, aggressive advertising? And then the methods of acquisition of assets. The method of acquiring assets. So you can acquire assets through inheritance or through buying more assets. So if you inherit assets, we don't say you are doing business. So that is the motive. That's the factors that we consider. And then when we are doing business, we receive we receive a variety of incomes. Not all incomes that we receive in business is taxable. So you need to know taxable business income. Not all incomes received in the business is taxable. So you need to know the taxable business income, which include insurance compensation for the loss of trading inventory or loss of revenue items. So when you insure, we have two kinds of insurance. You can insure revenue items or stock items or capital items. Capital items includes your non-current assets. So if the risk occurs and you are compensated for the loss of that particular inventory item, the compensation from the insurance company is considered as income for tax purposes. If the compensation relates to the inventory items or revenue items. But if the compensation relates to non-current assets, then it is not a taxable income. Sawa. So to you, if you receive all form of compensation, you will consider them as income. But for tax purposes, they only consider the compensation that is revenue in nature. Number two, the realized foreign exchange gains. So if you're doing business internationally, sometimes you are favored by the exchange rate. For example, you're selling goods to Sudan. The time you're selling, the Kenya to dollar, $1 was equivalent to 10 shillings. By the time you're selling your products to Sudan, and then maybe you sold 1 million items. And then by the time you are being paid, $1 is exchanging at, there's a gain of how much? 2 shillings. So we say realize. Realize means you've already received the monies in your bank account. That is what it means, realize. Not that you anticipate, you estimate. No. Unrealized, not. The one that you already realized. You've already been paid and the money is in your account. That is what we call, that is taxable income. And then there is what we call the balancing charge and trading receipt for wear and tear allowances. So there is what we call investment allowance. So investment allowance is an allowance that is given to businesses for investing in non-current assets. So for example, nowadays the furniture is 10%. So you buy a furniture that is equivalent to 10,000. That is the cost of that furniture. You're given an allowance of 10%. An allowance means you use that amount to reduce the taxable amount. So you're given an allowance of 10%. So the written down value here is how much? 9,000, isn't it? Now, if you decide to sell this asset and the amount of money you sell is greater than the written down value, the gain is called a trading receipt or a balancing charge. A trading receipt, if the business is still a going concern or still in operation, or a balancing charge if the business is under liquidation. So a trading receipt is a taxable income. So you're selling, a trading receipt is where you sell an asset above the written down value. The written down value is the cost minus the investment allowance. So if you happen to sell an asset, a value that is greater than the written down value, then that one is a taxable income. Then there is what we call bad debts recovered, which were previously written off and allowed. So sometimes you write off some debts. When you sell on credit, some debtors are not complying they're not complying in terms of payment. You decide to write it off. You don't inform them that you've written it off, isn't it? When you write off a debt, you don't become emotional and you write very bad letters. You just keep quiet. Maybe that person, after some times, he can decide to pay, isn't it? So he had already written it off. But now, after some time, he pays or she pays. Then that one will be treated as a taxable income. So when you write off bad debts, you just keep quiet. You don't tell the debtors that I've wrote off the date. And where business is carried on partly in Kenya and partly outside Kenya, the profit for the business is deemed to have been generated in Kenya. So if you're doing business in Uganda, partly, and also in Kenya, so you're generating revenues from both ends. So that one will be treated as an income in Kenya. And then we have what we call a reduction in specific provision for bad and doubtful debts. So we have general provision and specific. So specific provision is a provision is amount that you set aside from your profit to cater for bad debts. So for example, you can set aside maybe 10,000. You say, I estimate maybe debtors equivalent to 10,000 not pay. So I want to stand in for them. So this amount, you obtain it from your profit. So you say, out of my profit, I'll reduce 10,000 to step in for those debtors that are likely not to pay. And then after some times, you find out that your debtors are very compliant. Everybody's honoring their portion. So there's no need this money to be kept in this account. So you reduce it. If you reduce it, if it is specific provision, then that reduction is a taxable income. Then you say maybe instead of holding 10,000, you should hold how much? The other 5,000, you return it back to business. That process, that reduction is treated as taxable business income. If it is specific, and the question will tell you very clearly it is a specific provision. And then, of course, lastly, a gain arising from buying and selling. A gain arising from buying and selling. So when you buy and sell, you buy at a low price and sell at a higher price. The difference is taxable income. So you bought an item at 10 shillings, and then you sold it at 12. The difference is how much? 2. And then you are selling 1,000,000 items. You're selling 1,000,000 items. So you are gaining how much? 2 million. So that 2 million is taxable income. We have some other income. For accounting purposes, they are considered as income, but for tax purposes, they are not. So you also need to know what we call non-taxable business income. So the incomes for the normal accounting purposes, yes, they are incomes, but for tax purposes, they are not. Number one is income from foreign investment. So if you invest abroad or in foreign companies, and then you receive such incomes, those incomes are not taxable here in Kenya. And then number 2, reduction in general provision for bad and doubtful debts. Reduction in general provision. Remember, specific, we said it is taxable, but general, it is not. And then additional capital that you introduce in business. Additional capital that you introduce in business is not taxable. And then another thing that I've not written here is gain on sale of non-current assets. That one is non-taxable business income. Gain on sale of non-current assets is non-taxable business income. Insurance compensation on non-current assets, that one is also not taxable business income. And then unrealized foreign exchange gain. Unrealized foreign exchange gain. That is non-taxable business. Unrealized foreign exchange gain. That one is non-taxable business income. So those are the additional that I've not included there. So those 2 things are very important. And then the key things, now the key items for you to know, and then now I know you will be able to get around 15 marks, is what we call allowable and disallowable deductions. So you need to know, in addition to those 2 things we've discussed, You also need to know what we call allowable and disallowable deductions. So allowable deduction is a deduction that is allowed to be reduced from your taxable income, so that now you are taxed on the net income. So allowable deduction for tax purposes is that deduction that assisted you to generate taxable income. Then you need to know those deductions. I've listed quite a number there. And then by doing more questions, we'll be able to know more and more. So number one is trade bad debts and increase in specific provision or allowance for doubtful debts. So bad debts, what are bad debts? Bad debts are those debtors that you have identified that will not pay you. You sold on credit, and then you have identified this particular debtor will not pay me, maybe because he's declared bankrupt or he's no longer in existence, he's dead. So that particular debt, you write it off, isn't it? So for the purposes, that one is allowed expense. You deduct it from your taxable income. Or increase in specific. The way it can reduce, you can as well increase. When you assess that your debtors are defaulting more and more, so you need to increase this amount. Any increase, maybe you want to make it 15,000. So the increment in specific provision is allowable expense. And then there is what we call capital allowance. We used to call it capital allowance. Nowadays, we call it investment allowance. It's an allowance. It's a topic on its own. We'll learn about it. This is an allowance that is given to businesses for investing in non-current assets. So when you're doing business and you buy non-current assets, there's an allowance that you're given. We'll learn about that allowance. So that one you just need. And then number three, legal costs in connection with the acquisition of a lease of not more than 99 years. So you are leasing an asset and the lease agreement is of less than 99 years. The legal costs that are connected to that kind of a lease, of course, when you're leasing an asset, you must engage the services of lawyers, isn't it? Lazima we engage lawyer, ama? So when you're leasing an item, an asset, mostly you'll have to have a lawyer. And the legal cost, provided the lease agreement is of less than 99 years, then that is allowable. And then subscription to a trade association. Subscription to a trade association. And then expenses of capital revenue in nature on scientific research related to the business. So if you're doing a business and then you sponsor scientific research, for example, you're running a hospital, that is your business. And then you sponsor a university student to do a research on a particular disease. Then you spend on them on both capital amount and revenue amount. Capital amount relates to equipment. Then revenue expenses, maybe the allowances when they're doing that particular activity. So both of them are allowable, so long as the research is related to your business. Yes. And then business pre-commencement expenses, provided that the expenditure will be deductible if it is incurred after the commencement. So we are saying there are some other expenses you incur before the business starts. If they are revenue in nature, then you deduct. If they are revenue in nature, you deduct after the business has commenced. But if they are capital in nature, if they just write their business pre-commencement expenses and they keep quiet, then they will not be allowed because maybe they relate also to non-current assets. And then number 7, interest on loans for developing the business. So if you acquire a loan, you pay interest on that particular loan. So if the loan is connected to the business, it is to develop the business, the interest you pay on that loan is allowable. And then advertising expenses of revenue in nature. So we have two kinds of advertisement. We have advertisement of capital in nature, like billboards. You erect billboards, billboards. And then neon signs. Those kinds of advertisements are not allowable. But the revenue advertising expenses, such as you advertise in newspapers, posters, radio, those ones. But signposts, those are capital, not allowed. So and then loss brought forward from the previous years with a limit of 10 years. So if you generate a loss in one given year, in the next year, that loss will be allowable expense. For example, this is 2023. Your business generates a loss. In 2024, that loss will be an expenditure allowable. Then number 10, legal fees paid on listing of securities to a security exchange registered in Kenya. In Kenya, if you're in Rwanda, registered in Rwanda. Okay. And then number 11, the cost of preparing land for farming, both revenue and capital expenses. So if you prepare land for farming, and then any cost incurred in the prevention of soil erosion. So those are some of what we call allowable expenses. And then you need to know what we call non-allowable. So maybe in the ordinary way of making your income statement for internal consumption, those are the expenses, the non-allowable one, you can consider them as allowable expense, maybe in your own internal use. But for tax purposes, they're not allowed. So we need to know them. So the tax person defines them as expenses that do not assist you to generate taxable income. That is how the tax person, the taxman explains them. So these expenses include any amount of money you spend on buying non-current asset. Any expenditure on acquisition of non-current assets is not allowable. And then number two, depreciation, amortization, and impairment loss. So depreciation is the loss of value of non-current assets, and impairment or amortization is the loss of value of intangible assets, such as goodwill or patent. So depreciation is not an allowable expense. That one you need to know. And then personal and household expenses. You see, if someone comes around your business, maybe you pay school fees for your daughter from the business income, and then you can't go ahead and treat it as an expense. It is not allowed. Or you maybe take refreshment for your friends who have visited your place of work, of your business, isn't it? You take them to hotel, and then you buy them food and other refreshment. That one is not allowable expenditure. Tunaelewana? And then number four, income tax and all expenses related to payment of tax. Anything called tax is not allowed, or any expenditure that is connected to tax, like maybe tax consultation fees. You go for consultation matters regarding to tax, and then you go ahead and deduct it as expense. It's not allowed. Like tax consultation fees, or you pay VAT and then you go ahead and deduct it as an expense. Not allowed. And then next, increase in general provision for bad and doubtful debts. Increase in general provision for bad and doubtful debts, not allowed. And then next is rent expenses. If the commissioner is not satisfied that it's an income in the hands of the recipient. This one means if you're doing business as a sole proprietor or a partnership, and then you're doing it in your own premises, in your own building, so rent cannot be allowed. If you are a sole proprietor, maybe this is your building, and then you are doing business in this building. You can't go ahead and deduct rent as an expense. Are we together? You cannot deduct rent as an expense. And then we have other expenses which over time are regarded as non-business expenses, e.g., donations and penalties, fines. So you are penalized maybe, or you are fined for reckless parking in town here. So when you park in town here recklessly without following procedures, or you park and you don't pay the parking fee, you will be penalized, isn't it? So that penalty, if you paid from the business, it cannot be allowable expense. Or you make donations to a political party. You donate to a political party. That is not allowable. However, donations are only allowable where they are to a charitable institution. In this case, we mean a church or a good church. We have some bad church, isn't it? So how do they're good? If you donate to a good church, you know a good church? How do you distinguish between a good church and a bad one? How do you know that this is a good church? Or if they are singing, the pastor wearing a suit, how do you distinguish? Or all churches are good churches? So when you donate to a good church or a mosque, a good mosque, and the children's home, that one is allowable. For your information, not all churches are good. In fact, 90%. 90% are bad. And then if you donate, and then if there is evidence that you've donated, for the donation to be allowable, it must be to a charitable institution, which is a church or a mosque or a children's home. And then there must be evidence that you've donated. And then you don't expect to benefit directly or indirectly from your donation. So some people will donate with the wrong motive. Some people start children's home with the wrong, to conduit people, with whom people to contribute, isn't it? So if the motive is wrong, then that thing is wrong. So the other expenses are not listed here. Like, for example, subscription that is not of a trade association is not allowed. Subscription to you subscribe to a golf club. That one is not allowed. Subscription to non-trade association, or loss on disposal of non-current asset. Loss on disposal of non-current assets is not allowed. Or legal costs in connection to a lease agreement of more than 99 years, not allowed. Legal, I'm very fast. Don't worry, we're going to do a lot of questions. This is a guideline, isn't it? This is a guideline. Now, for you at your level, once you know the allowable and disallowables, once you know allowable and disallowables, then you are able to do these questions. So those are the guidelines, and then we'll do more questions and be able to know. So they test you on 3 kind of business entities. So they test you on how to compute the taxable income and the tax for sole proprietorship business, for partnership business, and companies. So those are the 3 organizations that they expect you at your level to be able to compute the tax. So when we talk about taxation of business income, we mean 3 entities. That is sole proprietorship, partnership, and companies. So now let us look at sole proprietorship, taxation of sole proprietorship. So the notes I've written here, sole proprietorship doesn't have separate taxable capacity. In other words, the owner and the business are the same persons. So you can't tax the business, you tax the owner using the graduated scale rate of tax, using the rate that you use for employment income. So salary to the owner and any drawings are not allowable. Salary to the owner and any drawings are not allowable. So it doesn't have the taxable capacity. And then taxation of partnership. The profit from a partnership are taxed on the partners. The partners share the profit as per the profit sharing ratio after adjusting for the following. So now a partnership business doesn't have a separate taxable capacity, just like a sole proprietorship. However, you tax the partners on the gains they're getting from the partnership business. So you need to come up with a distribution table, we'll do it, where you indicate the gains that a partner got from the partnership. For example, you can be given a salary as a partner, that is a gain to you. You can be given bonus, that is a gain to you. You can be given interest on your capital you contributed to the business, that is a gain to you. Alternatively, you can also be given a share of the profit. So those are the things that are taxed on an individual partner, not as a firm, not as an entity. Partnership doesn't have that capacity to be taxed as an entity. So any form of remuneration to the partners, interest on capital, and drawings are not allowable. So salaries that you pay partners or any interest on capital is not allowable expense under partnership. Interest on drawings and capital introduced are non-taxable, are not taxable incomes. So we'll do questions on partnership and then you'll be able to know. And lastly is taxation of corporations or companies. Corporation and tax on corporate tax rate of 30% for resident. We know what is a resident company, and 37.5% for non-resident. So a resident company is taxed at 30% and non-residents at 37.5%. Salaries to the directors are allowable expenses. Transaction between the business and the shareholders are considered to be business transaction for tax purposes. Income from other sources is added to the taxable profit and taxed on the aggregate. So now, at that point, you need to know how to adjust the taxable income. You need to know how to adjust the taxable income. So depending on the statement you are given in a question, you can be given a statement where they have already computed they have given you the net profits. So they have come up with the income statement and they are giving you the net profit, okay? And you need to adjust the taxable income. So how do you adjust the taxable income where the statement you're given indicates a net profit or a net loss? So you start with the net, you start with the reported net profit stroke loss. You start with that one. And then if you're given net profit or loss, it means there were expenses deducted, isn't it? In arriving at that profit, isn't it? So you analyze those expenses and then you identify those ones that were not supposed to be deducted. We call them disallowable deductions. So you add disallowable expenses. You add disallowable deductions. You add disallowable deductions. So in that statement, when you arrive at the net profit, it means you have deducted expense. So you check one by one. Which of these expenses that were deducted were not supposed to be deducted? And then you add back. You also add understated income. Understated income. If there is any income that was understated, you add back understated income. So you add back understated income and any omitted income. You also add omitted incomes. If there is any income that is omitted, you add back. So the question will tell you. And then you less omitted allowable expense. Omitted allowable expense. If there is any expenditure that was supposed to be allowed and it was not, you will deduct. And then you less, there will be some income for that. Unajua kama umepewa net profit inamaanisha kuna incomes na kuna expenses, ndio? So you'll go to the income section, identify non-taxable income. So you less non-taxable income. Non-taxable income. Non-taxable income. You less them here. You less non-taxable income. And then you less understated expenses. Understated expenses, you less them here. And then you also less income from specified sources. Incomes from specified sources. Income from specified sources. What are these income from specified sources? If there is any other income that is taxed on its own and is combined together with business, you eliminate it from business income. For example, you can find that in the normal accounting, we're going to mix business income and rental income. If you have a rental property, isn't it? After the gross profit, you say other incomes. Tunaongezea nini? All other incomes that you have, isn't it? So if you've done that, you need to deduct there. Then here you get what we call the adjusted taxable income or loss. Adjusted taxable income or loss. So when you get a question on this, any question that want you to determine the taxable income, so first of all, check, have you been given the net profit or the net loss? If you're given the net profit or net loss, this is how you start it. In some other question, you just be given the details. There's no statement that shows net profit or loss. So from those details, you'll be given the details of incomes, the detail of expenses, and other details. So that one, you'll come here and compute. You start by compute sales, you compute sales, you take sales, and then cost of sales. From those details given, you less sales here, cost of sales, you get the gross profit. And then you identify other business incomes like discount received, other discount received, other business income. You add here, discount received. And then you less allowable deduction. Here you less allowable deductions. So you opt for this option, you opt for this style. In question where we've just been given details which do not show the computation of the net profit or loss. But where you have been given this is how you do it. So that is how, those are the details you need to know in order to handle questions on business income. So far, I have talked a lot. Anyone with a question? Anything that is not clear that can be repeated? Anything that is not clear that can be repeated? So now you write your name here and you sign for me. So in most questions, in most of your exams, you will always you will always get a question on business income. It is always there. So now I think we can get one. We can just do one for partnership. So they are fond of bringing partnership and companies. So I want us to do one question on partnership. And then, of course, we'll pick on from the next. So May 2019, I think we can do May 2019, not even May 2019, just let me see. We can do, okay, let us do November 2019. November 2019, question number 5C. November 2019, question number 5C. So we are doing November 2019, question number 5C, taxation of business income. November 2019, question number 5C. This question are examined both in ATD and CPA. So they are the same. Tax is the same. Even those one, if you do this tax, you can as well do the advanced tax because tax is the same. So we have a question that was done in November 2019, question number 5C. The question reads, Teddy, Rachel, and Michael are partners trading under the name Taram Enterprises. They share profit and losses in the ratio of 4:3:3. The partners have presented the following income statement for the year ended at 1st December 2018. So you have the income statement you have been given there. So you have been given the income section on the credit side, and the debit section has the expenses. And then you have been given the net profit there. I hope you can be able to see. And then we have additional information. It has been the firm's practice to value the stocks at the cost price. However, the closing stock amounting to 180,000 was valued based on the net realizable value, which is 10% less of cost price. Salaries and wages include salaries amounting to 40,000 paid to Rachel. Number 3, advertising includes 10,000 spent on advertising campaign to introduce a new product in the market. And number 4, legal fees include a sum of 12,000 paid as parking fine and penalty to the county government. And number 5, capital allowances have been agreed with the Commission of Income Tax at 90,000. And number 6, steady other incomes include 120,000 consultants fees. He has brought forward partnership loss of 135,000 from the assessment of the year of income 2017. And number 7, Rocho has income of 200,000 from bet winning. She has brought forward partnership business loss of 135,000 from assessment of the year 2017, of the year of income 2017. Required Roman 1 taxable profit or loss of the partnership for the year ended at 1st December 2018. And then allocation schedule of profit or loss are calculated in 1 above 2 marks. And then total taxable income of which of the partners for the year of income 2018. Total marks 12. So this is a typical question that you can get in exam. So the first thing you check, as I told you, have you been given the statement that shows the net profit? Yes, this one has the net profit. Net profit means there were incomes and there were expenses. So you start by writing the name of the firm. So here it is Teram Enterprises. Teram Enterprises, computation of taxable income, computation of taxable profit, of taxable profit. Year of income 2018. And then you underline. And then you write here shillings and thousands. So you can write here shillings and thousands. So every time you're given profit or loss, you start with that one. So start with the reported net profit. Reported net profit. So the reported net profit is how much? The reported net profit is 1040. Can you see it? Ama tusimamia hapo. How do you see it? Tusimamia hapo. Tutaendelea next time. Wangapi wanasema tusimamia hapo? Tutaendelea next time. Ule msichana sasa. Wewe. Tusimame ama tuendelee? What do you see? We pick from there next time. Okay. So, some are saying we stop. How many are saying we stop? We'll pick it from there next time. So it seems you guys, your energy level has gone down, isn't it? So we'll start from there next time. So make sure you sign there, but you do the assignments. You do the assignments. So we'll finish up this topic next time. So you already laid the foundation. So pick there from next time. If you're an online student and you're listening to us, please, we want to know whether you have the notes. So tell us. That is the end of our class today. And we'll pick on from next week. Sawa sawa? So utafanya zile assignments za employment income.